This is DJ Van Keuren with the Heyman Family Office and the Family Office Real Estate Magazine. I happen to be in London with a good friend of mine, Akhil Patel, who we've known for quite a number of years, but haven't had a chance to meet. So
yes,
super excited about that as well. And how this all came about was because I wanted to start to really dig into market cycles and really understand them. And in fact, I think I told you that I had put out a survey to a bunch of families a number of years ago. I did a small sampling and then a large sampling, and the almost same statistical number came back. That family wanted to know, 67% of those, where are we in the real estate cycle?
Right.
So what I wanted to talk to you about here briefly today is you know, a lot of people think something's going to be happening.
Yeah.
They're not sure when, especially because we've had such a good long ride since the downturn. How far back can you actually go when you're looking at historical evidence of market cycles? And is it one country, multiple countries? You know, how long is that history?
Okay. I mean, you can track the real estate cycle back to at least 1800 in the US and even a little before in the UK. So we're talking about a cycle that is in operation for over 200 years. And the reason that I mentioned the UK and the US is because those two countries have had probably the least internal changes over that period, and also we have the data. But certainly since the Second World War, you can see the evidence of the market cycle in Eurozone countries, or what are now Eurozone countries, in Japan, in North Europe, and starting as other countries develop, they're starting to exhibit the same market cycle as well. So
I know that you also do research. Obviously, this is about real estate. That's the area that we focus on. But does the stock market have a correlation with the real estate cycle? And if so, are there increases before you're about to see a real estate downturn, or does it happen at the same time? How are those two correlated?
Yeah, I mean, it's a good question. So the short answer is yes. The stock market tracks the real estate cycle pretty closely, though of course you know, the ups and downs in the stock market have other reasons for doing it. It's not just about sort of the real estate cycle. What you tend to find is that the stock market starts to increase first at the start of the cycle before the real estate market, and peak. It may peak. The broader index might peak around the same time, but real estate stocks by that point are already falling. So the investors in real estate companies are starting to anticipate the real estate downturn, and so are pulling money out of such stocks. But if you take the history of US stock markets back to 1800, the median fall in stock prices at the end of the real estate cycle, when the economy is entering a recession, is 48%. So they're very significant stock market events timed to the real estate cycle.
That sort of tells me you should probably short stocks.
Yes, if you could. I mean, these days you can short the broader index.
Yes.
The best candidates for shorting are bank stocks, particularly stocks that have gone too far in terms of lending during the prior boom. I mean, you have to be a little careful because some banks then go completely out of existence. But you can make some really good returns shorting bank and real estate stocks in the downturn.
All right, so today is the third week in November 2018.
Yeah.
Based upon what I've read and you know, from your data, your information, us speaking, and everything else, that we should be seeing a downturn in the next 12 to 18 months. Is that fair to say?
Yes, it would be. So in my research, I call it the mid-cycle slowdown. There tends to be a bit of a dip, if not a proper recession, at the middle point of the cycle. It tends to be relatively less severe than the downturn at the end of the cycle, and usually economies get out of them fairly quickly. But yes, we've got that coming up in the next 12 to maybe 24 months, depending on what actions policymakers take.
So we can go back, like you said, to the 1800s.
Yeah.
So a long time.
It is, yeah.
why do you think the cycle continues to repeat itself?
The cycle repeats itself because ultimately it's driven by land speculation and bank credit, which are two features of the economy which have not changed. And essentially, when asset prices are rising very quickly and credit's very available, everyone is very bullish, and everyone wants to earn good returns, and so there's a natural incentive to put money into the assets which are appreciating. But the thing is that can go too far, as we've seen in the run up to the peak in 2006, 2007, and when it turns down, it brings down the banking system with it, because bank collateral is severely damaged, balance sheets are in very bad shape, and when credit is sucked out of the economy, you have a major recession, and then of course government has to intervene and try and sort out the problem, and that takes a few years to do it, and then by that point there's pent up demand and businesses start to invest and the cycle turns again.
So would you say that a lot of it has to do with human greed or the way that we respond to opportunities?
Yes, exactly. The incentives have not changed in 200 years. I mean, the economy of 1800 was an agricultural economy with relative to now hardly any technological development. But the incentives to put money in assets, to over leverage, etc., human greed and human fear, and then to be fearful when the market's turning down and to pull money out, etc. These things are constant parts of the human nature, and until that changes, you'll continue to get a repeat of the cycle.
So how long do you think this downturn will last, if you look back at history?
The mid-cycle?
The mid-cycle, yeah.
Typically it's about half a year,
okay,
sort of thing.
So 6 to 8 months, 6 to 9 months.
Yeah, exactly.
Probably.
So in the equivalent period in the last cycle was in 2001, and the US had a 2-quarter recession. The UK actually avoided a recession, so you don't necessarily need to get a technical recession, but there was definitely a slowdown in activity. The property market went through a period of a few lean years. People were uncertain, so they probably stayed out of the market for a bit of time.
Mm-hmm.
But they end up being relatively easy compared to the downturn, the end cycle, to get out of. And policymakers congratulate themselves on being able to manage the economy so well to pull them out. Of course, what they're doing is really setting up the economy for the second half of the cycle, which is much more bullish, and then of course into the peak and then the major downturn at the end.
Okay, so then when could we expect a recession?
The mid-cycle, well, I consistently forecast it for 2019.
Okay, that's the mid-cycle. I'm talking about
the top.
Take off.
Yeah, the peak.
The peak.
Yes, so by the early 2020s at some point. So I just want to say something about the mid-cycle before I get to the peak. So 2019 is the third year of the US presidential cycle, which tends to be almost the best year for stocks and so on, because the government is trying to do as much stimulation of the economy to get things looking good before the
next election.
Yeah, so that might have an impact in the US. And of course, if the US avoids a recession or is in expansion mode, it might either delay the recession or the US might not have much of a recession. So the timing may be affected by certain events. That will set the early 2020s will be out of the mid-cycle period, and I've consistently again forecast the peak for around 25, 26.
Okay, which means that we should be going into a actual recession around 25, 26.
Yes,
right?
Yeah, or after that, yes.
Okay, so
a major. It's a very significant event. You want to be very careful in the run up to it.
Okay, so you've heard it here first that we need to make heyday after this sort of mid-turn down cycle, and then we'll need to look in 25, 26 where we'll hit another recession basically, and if those are fortunate enough to go along those guidelines. I think I told you before, for the last downturn, my patriarch, he had sold 80% of his portfolio, moved them into Walgreens, said people aren't going to stop needing medicine.
Exactly, yes.
He did say the 2 years after that was the 2 most boring years of his life because there was nothing to do. But then he redeployed that capital, and he basically took it from 150 and tripled it
Yeah.
You know?
Yeah.
Because he was buying low. So,
Exactly.
so once again, this is Akhil Patel, and we're forecasting the downturn in the real estate cycle, not only in the short term but also the long term. And I gotta tell you, I am so happy we finally been a chance to meet.
Yes.
And I expect this to be the first of many times to.
Fantastic.